we've got American General on the call this morning, and also Mike Murphy is, and also Tom Van, who's been gracious enough to take some time out of their day. Actually, you guys are an hour earlier than us, right? So it's 8 o'clock, I think, where you guys are. So
you are kicking off the day for us, Roy.
So take some time out of their day, and we're going to, American General, this is going to be kind of like an overview, not to steal Mike's thunder, but, there's a lot of different things in American General. Some we probably will cover here, some we may not, like critical illness, for example, some of the accident or life and health type products, or health products, I guess I should say. So this is really just kind of a reintroduction, if you will. And so if you guys, as always, if you got questions, you can type them, and I'll ask them, and you can listen for your answer. Or if you'll hit the little raise your hand button if you got a microphone or you're on the actual telephone, and we'll unmute your line and you'll be able to ask a question. So whichever one you feel comfortable with, we can certainly accommodate you. So Mike, I'm going to go ahead and turn it over to you and Tom.
Great. Thank you very much, Roy. And thanks for giving us some time this morning. And thanks to all you folks for joining us. We appreciate you spending part of your day with American General. It is 8 a.m. here in Milwaukee, what looks to be a perfect day, so I hope it's good where you are. What we're going to try to do today, as Roy said, given some of what we went through in 2002, 2008, 2009, I think a lot of people just kind of forgot about American General and kind of moved away from us for a period of time. We have come back in a big way, but I think we're at a point now where we just kind of need to reintroduce ourselves. So I thought what I would do is spend a few minutes just talking about the company, what's going on at the company, talk about a little bit about what we think is going on in the marketplace. Then we'll look at our portfolio of life products, not in any tremendous detail, but just to kind of point you to where some of the markets are for those products where we're having success. And then I've got a couple of other miscellaneous things related to operations and so forth. But obviously in one short webinar, it's hard to cover everything, but hopefully we'll give you a broad reintroduction here. And then if there's something you want to know more about, we can either take care of that immediately by sending you some material or speaking with you, or we can schedule a more in-depth session on any particular topic. So with that said, I'm going to launch into it. There we go. First, before we get started, I'd be remiss if I didn't say thank you to those of you who've been with us over the years. Our business is doing very well after a couple of tough years that occurred through no fault of our own. But we were up 17% last year over the prior year, and we were up considerably over that so far this year. So we appreciate the loyalty and support of our distribution partners. We know there's a lot of other places to do business, and we appreciate what you do with us, and we're going to do everything we can to try to earn more. Having said that, I thought I would update you just a little bit on what's happening on the AIG front. Really, the news there is extremely good, but not that we talk a lot about AIG anymore. We try to brand ourselves as American General, but certainly the news on the AIG front is pretty good. And I'm not an investment banker, so I'm not going to attempt to explain any of this stuff in tremendous detail. But basically, AIG is in a position now where they have repaid the government. The government is in a position now where they still own some assets and they own a bunch of stock, but that number is getting smaller all the time. Currently, and there's a new stock sale planned now, but you could see, starting back at the beginning with $182 billion of authorized assistance to AIG, that number now is down to about $45 billion, and that's, again, the government can get out of that anytime they want by selling off the stock or the assets. So it's not like we need to stroke them a check at this point in time. So As far as getting the government out of our hair, I mean, they still own a lot of stock, but they have already sold a bunch at a profit, and we expect they'll continue to sell more at a profit, and could be totally out of AIG as early as sometime next year. Some of the more recent news, again, the GAO report that came out recently, just a couple of things from Twitter here, says the government could actually make $15 billion on this DLE assistance they lent to AIG. We had a very good first quarter at the AIG level and the American General level with net income of over $3.2 billion. And again, it was just last weekend that the Treasury announced they were going to sell another $5 billion of stock, which is going to bring their remaining ownership down to about 63% of the company from currently 70%. So things definitely trending in the right direction at the parent company. We, of course, are part of SunAmerica, and that's a big company unto itself, which rolls up to AIG. Just to give you some perspective, SunAmerica Financial Group, which includes all the companies you see on the left-hand side of the screen, which includes American General and VALIC and Western National and some of the broker-dealers and AGLife, American General Life and Accident. That makes up about 50% of AIG today. The other 50% or close to it is made up of Chartis, which is a bunch of companies in the property casualty end of things. American General, the company that I work for and that you represent, makes up about 40% of that SunAmerica piece. So we're about 20% of AIG. So AIG is a smaller company than it used to be, at least in terms of entities, but American General has a big seat at that table, both on its own and as part of SunAmerica. As far as American General goes, I'm just kind of working my way down the food chain here. I would say I've been with the company for 15 years almost, and I've been in the industry a whole lot longer than that, dating back to 1974, however many years that is, too long for me to count. But our balance sheet has never been stronger than it is today. For those of you who may have done business with us back in 06, 07, early 08, before the financial meltdown, we were considered to be a powerhouse in the industry. Our balance sheet today is stronger than it was then. Our risk-based capital ratio is nearly 500%. We're bigger, we're stronger. As far as troubled assets, those have all been taken out of the company. And as a regulated insurance company, which is really what's important to your clients, we're the only ones responsible for our contracts. American General is as strong, if not stronger, than any company out there today. That's a little bit about the company, and again, if you want to know more about any of that, there are pieces that Tom can send you, or I can send you, or Roy probably already has. But I don't want to dwell too much on that. I think the company is in better shape now than it has been for some time. So let's talk a little bit about the market. And kind of to set the stage for that, I thought I would reference just briefly a study that SunAmerica did in 2011 called the Retirement Reset Study. This was a repeat of a survey that they had done many years earlier to examine people's attitudes towards retirement planning or approaching retirement. And they wanted to take a fresh look at it following the economic crisis of the 2000s and the recession and so forth. And we don't have time or the inclination to dig into this thing in great detail. If you want to see it, we certainly can send that to you. But I think there are some conclusions that came out of that survey, some very high-level conclusions that will lead us into a discussion of our portfolio. And I think the products that we sell and that you sell, both with us and with other carriers, are pretty well positioned right now for what the consuming public is seeking. basically the broadest conclusion I think that we could reach is that Americans are seeking what you have to offer right now. And more than anything, they're seeking assistance. But one of the first major conclusions that came out of this is that people are much more concerned today about security, peace of mind, and holding on to what they've got than they are about real aggressive wealth accumulation. Yes, they want to accumulate wealth, and they know they have to, but they're a little bit lower on the risk meter than they were 3 or 4 or 5 years ago, and much more concerned about security than just go accumulation. There was also a lot of things that came out of the survey that talked about family obligations. There's a lot of people in my age group or a little bit younger. I'll be 62 this year. People a little bit younger than me, a little bit older than me, who are taking care of parents who may be, certainly elderly, but probably not well either physically. Many of them are also assisting their adult children who've had difficulty moving on with their careers in the difficult economic environment, difficulty finding a job in their desired line of work. And then, there are also, families out there with special needs, etc. But, the bottom line here is that about 50% of the people who responded to this survey had financial concerns about people who might survive them. What if I die too quickly? I'm going to leave people behind that are somewhat dependent on me financially. That sounds a lot like a life insurance need to me. So there was a lot of stuff about, the number of people who may need to give assistance to adult children or grandchildren, or even to their siblings who perhaps have been more affected by the economic downturn than they have, than the people responding have. That kind of leads us a little bit into our portfolio. We'll come back to some of these conclusions as we go along, but certainly if you're in the life insurance business, a lot of what we just talked about for the last 5 minutes was right up your alley. People are looking for what you sell, but they don't presume to understand that they need your help to figure out what they need and how much they need. American General, if you've been with us for a period of time, as I said, I've been with the company for almost 15 years, but I know many of you have been around nearly that long in one form or another. We've got a long history of, very robust product development. We've brought a lot of products to the market. I think we've brought a lot of interesting and different products to the market, and that tradition really continues. We really pride ourselves on a few things in our product development area. One is a culture of innovation. We were the first to market, for example, with a global index product. We've got a term product that doesn't look quite like any other. We've always managed to tweak little things in our products to give them a little bit of an edge. You'll see that in our guaranteed UL. Speed to market. We're able to respond to the market pretty quickly. We put out a lot of products. Some might say too many products. I think some of our systems people might say too many products because they have to figure out how to get them all administered in a short period of time. But we are quick to respond to market trends. But yet we maintain discipline, and I think that's more important than maybe in the index market. You'll see that we don't play a lot of games. We try to illustrate and sell our products straight up and let them speak for themselves without using a lot of smoke and mirrors typically. And we'll talk a little bit about that. So let's start to examine our portfolio, and I thought I would start with term. I know a lot of you know us for term. We are a lot more than term these days, but certainly this is a good place to start because we're well known as a term carrier. We used to own the term market. I think back in the mid-2000s, we were number one for about 5 years in a row. We had about a 10% market share at that point. We're getting back there. We're not number one today, but we've got about a 6 or 7% market share and growing. And we certainly are interested in climbing up that ladder. But more importantly, I think what we've got today is not only pretty competitive price-wise, but it's different. And if there's any market where you might ever want to differentiate yourself in ways other than price, I think term is a good example. So if you look at what we bring to the table, our basic guaranteed level term product, which we call AG Selected Term, we offer 17 different durations of term, not just the 4 boxes that most companies offer, which is the 10, the 15, the 20, and the 30. That may or may not be important to you, but we'll examine some reasons as to why we think that makes sense in the market, and why we continue to pursue that approach. On the right-hand side of the screen, a lot of people have forgotten about return premium term. There used to be a lot of companies in this space. Today there's about 4, but we remain in it, and we remain very competitive in it, again, with a different-looking product. We have a choice of 16 different durations, all the way from 20 years out through 35 years, and the opportunity to get your money back, all of your money back at the end. Not going to talk too much about that today, but again, people have forgotten about that product, I think, because there just isn't a lot of noise out there with only 4 companies in that space today. And then lastly, we've got a couple of interesting riders, which I'll mention a little bit as we go on, but one is the Select Income rider. What that rider does is it recognizes that there are really 2 types of insurance needs for your typical family situation, and maybe some business situations as well. There's a lump sum need following the wage earner's death, and then there's maybe a need for ongoing income. And historically, we've provided that ongoing income by just buying a bigger lump sum and leaving that to the beneficiary and say, knock yourself out, go live on this. And that'll work if the beneficiary is sophisticated enough and investment-oriented enough to manage that money, or we'll go out and purchase an immediate annuity or whatever. But the Select Income rider, what it allows us to do is package up a term policy with some lump sum and some ongoing income, so that we guarantee the beneficiary will have somewhere between 5 and 40 years of ongoing income, depending on what they choose to purchase, that they really can't outlive or outspend. I mean, they can outlive it because it's a certain number of years, but it's going to last for that number of years. They're not going to spend it away before the end of that period. So it's almost like an informal trust. Removes the investment aspect from the beneficiary's responsibility. So again, what do you need 17 durations of term and 16 durations of return of premium for? Again, our approach here is one size doesn't fit all, and real life doesn't always happen in 10, 15, 20, or 30 years. Real life happens in all kinds of different durations, and if you don't have all those durations to choose from, you're either selling too much or too little in terms of coverage. So we're able to match a need very precisely, and we're able to do what we call laddering policies, in fact, for multiple needs. So if you've got a client that's got 3 needs, maybe making sure there's an education fund for their children if they die, maybe insuring their mortgage, maybe providing some insurance to replace their income if they die. Those could be 3 different durations of need, and yeah, you could lump them all together and buy yourself a nice big 30-year term, or you could split them up and do an 18-year and a 22-year and a 27-year, and you're going to save that client money not only initially, but over time, as that as the children grow up and leave the house, that 18-year term expires, they're no longer paying for it. So we're able to, again, differentiate ourselves, show something to the client that goes beyond, how much per thousand. I'm going to show you how we also can use this flexibility to save a case or save a premium. Talk a little bit about another rider. We have the DI rider, and then of course we've still got return to premium, which most companies no longer do, and we're very price competitive in that market. We repriced our product just shy of 2 months ago in March. It's kind of an all-over-the-board reprice, to be honest with you. So a lot of rates went up, some rates went down, many stayed the same. The overall objective of that was to remain pretty much in the same competitive position. So where we needed to move up a little bit, we lowered our rates. Where we were already pretty comfortable with our position, we either left the rates unchanged, or in some cases raised them because we were more competitive than we needed to be. We don't strive to be the price leader. That's not our value proposition, but we do strive to be in that top tier of companies. And you can see here, given all the premium sales in the 15, 20, and 30-year space, we rank right up there in the top 3 to 5 a good percentage of the time. I will tell you, in the interest of full disclosure, we are not terribly price competitive at 10 years, or a 10-year duration, and that's by design. So if you're looking for a low-price 10-year term product, while it may pain me to say it, don't look at American General, because we're not going to solve your need there. But once you get up into the longer durations, anything 15 and above, we're pretty price competitive. We are banded, so the more you buy, the cheaper it gets. We do pay commission on the policy fee under $250,000. So on those smaller cases, if that's your market, you're not going to give up commissionable premium. We do pay on the commission on the whole premium up to $250,000. So still very competitive price-wise in term, but again, we've got some differentiators that some of those other companies don't have. We've got a quoting tool, Roy. I don't know if you folks use this or not, but it's called Rapid Rater. It's available in just about any form you want, and it's on the web. There's a desktop version. There's an iPhone, an Android application for people who want to do quotes on the go. This is a great quoter for term or guaranteed UL, and that you put in about 5 pieces of information about your client, and it'll show you the rates for every plan that is available to that client. Again, it's not password protected, so if you want to use the web version, Roy or whoever, you can put a link to this on your website. If you're the type that lives off your iPhone or your iPad, you can do the mobile application, or if you're an old desktop kind of guy, we've got a desktop version as well. Again, Tom Mann can hook you up with this, and it's a great tool. This is what it looks like. I'm not going to demonstrate it to you today. This is just a screenshot. But
hey, Tom, if you want to go ahead and send me that, we're actually going to put that up right now. So if you can go ahead and send me the link or send it to Barb, we'll actually have it up by the time we get off here.
Okay. So Tom will have to leave my office to do that. So if you look at the screen here, you see the left side of the screen where it says client data. That's really what you have to put in. So on the display, you select the product. In this case, it's select a term. It could have been ROP term. It could have been guaranteed UL or whatever, the state. So you always make sure you're getting the latest state approvals, the gender, the age, the face, the mode of premium. And if you don't have a rating, that's it. You click submit, and it shows you, as you can see, every class, the premium for every class based on what you've told me. So this guy's 45 years old. He can get every plan we've got all the way from 10 years out to 30, and we show all 6 of our non-rated classes the premium for that. If I wanted monthly, I'd go back and click at the monthly, and those numbers would change to monthly. So it's a great tool to look at the breadth and the flexibility that this product offers. So Tom will send you the link for that, or I can do it as soon as we're done. One way we use this tool, I mentioned a moment ago, is to save a premium or a case. Here's an example. Take a 50-year-old for 30-year term at $500,000. You thought he was going to be preferred plus at a premium of $1,569. Something comes up in the medical exam or the lab work or whatever that he comes back as preferred rather than preferred non-tobacco. So his premium would jump. You read across the bottom line, it would jump to $2,004, which is about a 30% increase or so. But if you can sell that, more power to you. But you don't want to have to go and start over with this case, requoting it or taking it to another carrier or whatever. So you can simply, if you want, just walk over to that preferred column, backtrack until you find a premium that looks about close to what you originally quoted. And you can see in this case it turns out to be 25-year term, or 24, depending on whether you want to go a little lower or a little higher. Again, if all we had was 20, that would be a big drop. You'd have to give up 10 years worth of coverage. But here for just 5 years worth of coverage, you can keep that same premium. In many cases, save that case without having to start over.
So rather than taking the focus away from the solution with your client, and now you're focusing on the increased premium, this gives a chance to dialogue with the client saying, if I could show you the same face amount, if I could keep it in the ballpark with the premium, would you still be interested? So now all of a sudden you have more engagement with the client, and you may find that your insured is going to gravitate towards that higher amount. So it keeps the conversation going, keeps the sales going, rather than just having a thumbs down, no, I don't want to pay the higher premium.
I see there's a question online. Should I answer that now, Roy, or? No? Roy?
Yeah, if you could, that was something that was sent to me. I don't know.
Okay. Yeah, somebody asked the question, said, can you answer this, Mike or Tom? Hi, looks good, but love those accelerated benefit riders the competition offers. That's a good question, or good point. I guess it's not really a question, but let me address it. Number one, we do have a terminal illness benefit in our policy, so that's one form of accelerated benefit. We don't have chronic illness, long-term care, or a couple of the other things that are out there. However, there is a movement underfoot, which we haven't made a lot of noise about yet, but our sister company, American General Life and Accident, really lives in that world. They have UL products they call Quality of Life that have all of those riders generally without cost available on their products. We are actually legally combining American General and American General Life and Accident, as well as a couple of other companies. And the guy who has been president of AGLife, Jim Mallon, is now going to be president of the combined company. This is an area we have a lot of interest in. Now, there's a lot of people, and there's two schools of thought, particularly in term. There are some that want low premium and nothing else, but there's certainly a growing number of folks out there who like the value that those other benefit riders add, and we definitely have plans to go down that road. And again, we've got those types of benefits out there through our sister companies, so it's not a big leap for us to start moving those kinds of things into our products. So stay tuned for that. But we do have terminal illness today in almost every state. Hopefully that answered your question. If not, please bring it up again. Whenever we can, I like to tell you about market niches where we may enjoy an advantage. This can save you time and point you in the right direction. I think I can say without reservation that we are far and away, almost always far and away, the leader in a rated term case pricing. Here's an example, and the reason for this is very simple. When most companies add a rating on term, they add it to standard non-tobacco as the base. Well, we don't. We have a special class base that's really between standard plus and preferred. So we are starting at a much more competitive base, and then we add our rating onto that, and we win that pricing battle all day long. There's only one other company that does anything close to that, and that's Banner. But you see here a 45-year-old non-tobacco, $1 million 20-year term. You can see premiums for several companies here at Table 2, 3, and 4. You can take our Table 3 rate of $32.54 here, and it is lower than every company's Table 2 rate except for Banner. Our Table 2 is lower than their 2, but even our Table 3 is lower than everybody else, and in some cases our Table 4 is lower than some companies' Table 2s. So if you ever get a rated term case, you need to be thinking about American General, and don't worry about whether one's 2 and the other's 3 or one's 3 and the other's 4, because we may still win that pricing battle all day long. And And the other piece of good news here, if you get Table 2 term with us, all of our single life UL products are priced to take Table 2 within the standard class. So you can convert that term to a standard UL down the line if you wish. I mentioned one of the riders. I just want to mention the other real quick. The select income rider I talked about, this is a way to take a portion of your death benefit. You could have a couple $100,000 in a lump sum to take care of immediate cash needs, but then have an ongoing monthly income of, say, $2,000 or $3,000 a month for anywhere from 5 to 40 years. Again, takes the investment responsibility off the beneficiary, kind of an informal trust arrangement. And that's an option the beneficiary cannot change. So they can't say, no, I don't want income, give me the lump sum. It is locked in. The DI rider is another way to differentiate yourself. I would classify this as a pretty simple rider. It's a couple-year benefit period with a 90-day elimination. You don't have a lot of choices here. It's some blue collar, some maybe lower end or white collar, gray collar. Probably not for the professional who's looking for all the whistles and bells of disability income. There is one particular niche to this. The limit on this is usually 50% of income that they will insure. But if you go out to somebody who already has DI, maybe a small business owner or an executive who's got 50% income through his employer or her employer, we will take another 20% to this rider, which you can attach to their term policy to bring their total up to 70. So it's a good way to A, give them 20% more coverage, but B, also give them a piece of DI coverage that is not tied to their employer. It'll go with them if they go somewhere else. And the rider is commissioned at the same rate as the underlying term. Again, a differentiator that is something to do with other than just price. Not going to talk too much about ROP term today. I think you know how that works. You pay a little bit more for your term coverage, but if you live to the end of the term, you get all your money back. Well, for that reason, it's a younger person's product, people who think they're going to outlive the term. It's a smaller case product, $250,000 to $500,000 average, very much a middle market type of deal. And a lot of females, interestingly enough. Most people do this for an emotional basis. It's, I really don't think I'm going to die in the next 30 years. Why do I want to give all this money to the insurance company if I can get some back? I'm willing to pay a little more for that privilege. But there are some analytical folks out there who say, wouldn't it be cheaper for me to buy a regular term and invest the difference myself? Well, leave aside for a moment the fact that that most people never get around to investing the difference. But we've got a tool that can help you look at that as well. It's called the Rapid Rater, the same one we looked at a moment ago. You just select a different display, and you do term versus return premium term. So let's go out to 30 years here, and it'll show you that if this guy's preferred plus, this is a male 40 for $500,000, he can buy a selected term for $629. If he wants to buy ROP, it's going to cost $1,285, which is just about double. Again, the question is, wouldn't I be better off buying the $629, putting the other $600 away on my own every year? Wouldn't I come out with more money in 30 years than I'm going to get here, where I just get all the money back? And what this does is it calculates what rate of return he would have to earn to do that. As you can see on the 30-year product, it's 4%. Now that's 4% after tax, guaranteed. Unlikely that most people are going to be able to find that kind of a return out there without taking on some risk, at least in today's interest rate environment. So this can help persuade somebody who's maybe a little more analytical. Now, no question, the shorter you go in your duration, the lower that number gets, because it's a function of time, how much time you've got to accumulate that return premium cash value. But even at 25 years, 3% is a whole lot better than most people are getting on any bank accounts or even CDs today. So again, a tool that can help you upsell some of your term cases to return premium term, even for those analytical folks. All right, that pretty much covers term, and if there are any questions, now might be a good time to ask, or we can do them at the end, but I'm going to, if there are none, I'm going to move on a little bit into guaranteed UL.
Yeah, and guys, if you got a question, like I said, you can, I know we've answered some in here. If you've got one, you can either type it and I'll ask it, and also if you've got a mic or something on your computer or you're on the telephone, just hit that raise your hand button and you can ask it. We'll unmute your line.
Yep. If not, we'll give you another shot later. Okay, so let's talk a little bit about our guaranteed UL products. Again, I think this is an area where we've built something that's a little bit different, still price competitive generally with what's out in the market, but have some additional bells and whistles perhaps that most other products don't. So let's revisit just for a moment the retirement reset survey and some of the conclusions that came out of that. There was a large percentage of people who said when they're talking about their insurance, they're looking for something that's guaranteed not to lose value, something that can provide income to their family if they die, something that allows them to leave money to the community or their family or charity. Again, a lot of that sounds like life insurance. And a lot sounds like guaranteed UL. Our basic single life flagship product we call AG Secure Lifetime GUL. And I want to spend just a couple minutes on it. Talk about some of the features it has, which are pretty common in the marketplace, and then a couple of others that may be a little bit less common. You can dial your guarantee to whatever you want. Typically an age, 121, 100, 95, 90. Nothing new there. We've been doing that for years, and most companies do. So you can dial an age, you can dial a duration, you can do whatever you want. What you're going to find in this product, though, unlike many, there's a couple out there that do, a few out there that do. This product accumulates a lot of guaranteed cash value. A lot of non-guaranteed value, but a lot of guaranteed value. And today that value typically kicks in somewhere between 10 and 15 years. However, we're going to be repricing this product in the next 30 to 45 days. That cash value is probably going to kick in a little bit earlier. The other thing that we do that I think is unique in this marketplace is we allow the policy owner to invade that cash by taking a partial withdrawal and still have a long-term death benefit guarantee to the original desired duration. We'll look at an example in a moment. So we provide very strong guaranteed cash accumulation. This product actually is designed to endow at age 121 for the full face amount. So you'll have guaranteed cash equal to the full face amount if the client lives to 121. But with them, we allow you to access that cash without giving up a guaranteed death benefit. Like most of our ULs, virtually all of our ULs, you have rolling targets, which are very competitive. Rolling target, of course, means that you got 24 months to maximize your first-year compensation. So you can afford to sell a shorter guarantee or whatever to help get that client's premium down, because some of that target may roll over to year 2 and you'll still get your full first-year compensation. We also have a standard plus class on this product, which we find historically takes about 15% of people out of the standard class and gives them a better rate. As far as price competitiveness, you will find us to be most competitive in what we refer to as the pre-retirement years. So pretty much up to late 60s, sometimes around 70. You could see green is good here. We're in the top 2-3 companies typically. You could see down the left-hand side there's all of our non-rated underwriting classes. Across the top is a variety of issue ages. You see a lot of green here. Some of it's even out at the older ages, or even some of the tobacco classes. But certainly our sweet spot is that 45 to 65 or 68 age bracket, where as far as price goes, we are very, very, very competitive. Not that we're totally out of the market at 70, but not quite as strong as we are at 60 or 55 or 65. Again, you can quote this product on the same Rapid Rater tool that I think Tom's in the process of sending. If he hasn't already, you simply select a different product set, Secure Lifetime GUL, put in a little bit of information, and it'll show you the premiums for guaranteed at 90, 95, 100, and 121. Then you can go into the software and run the whole proposal that shows cash value and all of that. This will give you a quick premium calculation. All you got to do is, again, the information that's shown on the left, tobacco or non-tobacco, so we could show you the right set of classes and so on. So this Rapid Rater is a great tool for these death benefit-oriented products. So you may be asking yourself, why is cash value important in this kind of a product? Well, I think, look no further than the current estate tax situation if you want to see the need for cash value and flexibility. We don't know what estate taxes are going to be in 8 months, much less in 8 years. With most guaranteed UL policies, though, there is no cash. There are very few options. You can keep paying your premium, or you can drop the policy. Cash value gives you flexibility and the ability to make adjustments later on. Take a look at this example, and I think what you want to take away from this is you're not paying extra for that cash value and that flexibility. So you take a 65-year-old here for $1 million as a guaranteed age 100. You can see our premium compared to several other carriers out there, very price competitive. We've got the rolling target, so the client's going to pay $19,000. But we have a $22,000 target. That means that $3,000 of the premium in year 2 is going to be commissioned at first-year rates. But then look at the cash value in 20 years. Most of these companies have no cash. With cash comes flexibility and choice. Here's an example. Take somebody who starts out at 65 with $1 million of coverage and a $26,000 premium. At age 85, we guarantee that they'll have $150,000 of cash. Let's assume at that point they're age 85. They say, well, I don't necessarily need $1 million anymore, and I could sure use some of that cash to help me through retirement. So we take a 50% withdrawal of that cash, take $75,000, put it in their pocket, downsize their policy by 50% as far as face and premium goes, but they've still got a guaranteed death benefit out to age 100 for that remaining amount. So basically they could cut their policy, in this case by half. They can go as low as they want. They just can't go below $50,000 in terms of remaining death benefit. So it's a great way to respond to changes in the future, where you don't need as much coverage, or you need some of that cash to help you through retirement. You can downsize your policy, but don't have to give up the idea of having something that's guaranteed for life on an ongoing basis. And as far as I know, we're the only company that does this, because with most guaranteed ULs, if you invade the cash value by loan or withdrawal, the idea of a guarantee blows up. You just don't have that option anymore. And we do this, again, responding to what consumers have told us in that reset. Guaranteed not to lose value. Everything here is structured around guarantees, strong death benefits, guaranteed premiums, guaranteed cash, and the guaranteed ability to access that cash without giving up your guarantee. I have a question online. Does the ROP include the policy fee? There is no policy fee on a return of premium product, so I guess yes, but there is no policy fee. So, nor is there any modal factor. So if you get a client that pays monthly, you just divide by 12. You don't have any little adjustment there for the fact that they're paying monthly. Thanks for your question. Everything I just talked about with regard to our Secure Lifetime product, which is our single life guaranteed UL, also applies to our new Survivor product, the Secure Survivor GUL. It's got the same competitive premiums, not quite as skewed to those 45 to 65 because this is an older age market. So you'll see we're more price competitive in the 70s and 80s, but it still has all those flexible guarantees. Still has very strong guaranteed cash. In fact, this guaranteed cash kicks in as early as 6 years. Still have the ability to access it and still maintain a guarantee. But now you're on a second-to-die chassis rather than an individual life chassis. This product is brand new. It's been out maybe 5-6 weeks. Also has a new benefit called the 15-year return of premium benefit, or more accurately, the enhanced surrender value, and I'll describe that in a little bit more detail. The enhanced surrender value rider is really what it is, but most people refer to it as a return of premium benefit. This is free. So people who want living benefits at no charge, I guess you can look at this as a living benefit. And there are only 2 other companies in the market that have this. So in addition to building up guaranteed cash and letting you dip into it and all of that, we provide an option. It's included in every policy. To make it work, you need to be funding a guarantee to at least 100. That's typically not true in this market. You don't have to pay premiums that long. You could be funding your premiums for as few as 1 year, but you need to be funding that guarantee out to age 100. And if you do that, at the end of the 15th year, we give you a 60-day, give the policy owner a 60-day window to walk away and get all their money back. Now, certainly they could surrender the policy at that point, but the cash value at the end of 15 years is probably only, it's going to vary, but maybe 20% of premiums paid. So a straight surrender would only give them 20% of their money back. With this enhanced surrender value rider, we give them a 15-year window to get 100% of their money back at the end of the 15th year. Of course, they have to give up coverage to do that, but this is the ultimate flexibility. So this can be done even if one of the insurers was uninsurable going in, where we do take one uninsurable. The other one has to be table D or better. And you can even do this if one of the insureds has already died. So yes, you have the ability to downsize your policy and take some cash out and keep some coverage going forward, but you also have the option to take all your money back if you no longer need the coverage at all after 15 years. So again, you may be asking yourself, well, you guys got a lot of flexibility other carriers don't have. You must be charging a lot for that. And hopefully this will demonstrate that that's not really the case. A lot of potential age and class combinations with a survivor product, but we've grouped some here. So see down the left-hand side, the respective underwriting classes of the 2 insureds. Across the top, you see the ages of the 2 insureds. And again, green is where we're in the top part of the market in terms of price. So you see a lot of scenarios here, even not only in those pre-retirement years, but out into the 75s or 80s, where we're very price competitive. And even the bottom row, where we've got somebody at table 4 and the other one at standard, you can see we're right in the hunt in terms of price. This is not a $1 million case. So you're getting a lot of extra flexibility, but you're not paying a lot of extra premium for it. This is the same type of deal I showed you before. I don't need to beat a dead horse, but a couple of 65-year-olds going in, buy a $5 million policy. 20 years later, $800,000+ of guaranteed cash. Take half of it out. That's a nice little bump to your retirement fund. And they're still able to maintain $2.5 million of guaranteed coverage going forward for half the original premium, and they, of course, retain half of the cash value. So some unique flexibility in both a single life and a survivor chassis. Any questions on guaranteed UL? How are we doing on time, Roy? We okay? I want to be respectful of people's time.
Yeah, you got about 6 more minutes or so.
Okay. I may have to whistle through some of this. That's okay. I'll go as quickly as I can. Okay. Another conclusion that came out of the retirement survey protecting assets is more important to people now than higher risk, higher returns. Gee, there's a shocker given what's happened to people's 401ks over the last several years. And people are more concerned, or at least equally concerned, about holding on to what they got as opposed to getting a huge return on it. Hopefully they can do both, but they don't want to err too far on the side of aggressiveness. This kind of leads us into the indexed UL market. And again, we've got limited time left, so I'm going to summarize some of this, and if Roy, if you want to do another session, we can. We are a pioneer in this market. We issued our first indexed UL back in 1997, way before most of the companies in it today. This is really a growth market, folks. Index UL premium, according to LIMRA, went up by 30% last year, not just us, industry-wide, and it now comprises 25% of the UL market. So it's a market that used to be considered kind of niche-y, but at this point, it's not something you can ignore anymore. Whether you choose to sell it or not, it's out there, and your clients are likely to hear about it. So I think it's important that you know at least how it works and what it's all about, so you can answer their questions. We've really got a range of product options, from the very classic plain vanilla elite index, which is S&P 500 only, annual point-to-point, to our global and global survivor, which is 3 global indices, typically a short pay, high premium product, 5 years, 7 years maximum premium. And then in between, we've got the product, our newest product, that probably has the biggest mass appeal, is it's a guaranteed UL chassis with index crediting. So you can lock in a lifetime guaranteed death benefit that will always be there no matter what happens to the index, but you can also accumulate significant cash by using one of the index crediting accounts. So we think we've got something for maybe not everybody. There are some folks that are not good candidates for index, but if you've got a good candidate, we think we've got a product for them. Why is index UL hot? That's easy to understand. Fixed rates, crediting rates on fixed products remain very low. The market remains very volatile. You can see on the bottom, this is just the S&P 500, but you can see the part below the line, that's what index UL eliminates. With even a 0% guarantee, we take those negative years out of the equation. And in fact, most of our products have a 1 or 2% guarantee, so it's even better than that. So the combination of the two, people looking to accumulate cash really can't do it in a fixed product right now. There's just not enough interest to be had. And most of them, as we've seen from the survey results, can't stomach the volatility of a pure equity-based product. Here's an example of what index UL does. You can see, if you just put your money in the S&P 500, not within an insurance product, you have some great years, but you lose 39% in 1 year, and then it takes you, 3, 4, 5 years of good years just to recover from that. Fixed rates, yeah, over time they've averaged 5%, but certainly not recently. You're looking at 4, 3.5%. But if you look back 7 years on our elite index product, probably the most plain vanilla product we have, it's pure S&P 500, but you replace those negative years with the 1% guarantee, and yeah, there's a cap or a participation rate that limits your upside a little bit, but you still come out with about twice what you could get in the fixed product over that period of time. That's what indexed UL is all about. Again, we think we've got some interesting options out there, probably not able to go into them in great depth today, but maybe just to point you in the right direction, I think if you got a possible index case, the product we have that fits the broadest spectrum of people is our new Choice Index. It's a guaranteed UL chassis. It's got a 5-year index account with global indices. It's got a 1-year index account with the S&P 500 only. But again, it's on a guaranteed death benefit chassis. We've got participating loans so that when you borrow money out, the borrowed funds can still enjoy index crediting if you want to take that approach. We've also got regular loans if you don't. So we think it's got the broadest spectrum of choice for your clients. And of course, it's got rolling targets too. So you may be asking yourself, why should I buy index UL and a guaranteed chassis? And why wouldn't I just buy your guaranteed UL? Again, here's an example. The blue line is our secure lifetime product, guaranteed cash. The red line is our index product at a 7% assumed rate of return. The client's going to pay $11,000 for the secure lifetime. A lot of those clients could stroke the check for an additional $2,000 and take the secure lifetime, get the same death benefit guarantee, but an IRR even at 30 years of 11% on that $2,000 difference in premium in terms of cash. Even at 5%, you're talking about an IRR of 14% in 20 years or 7% in 30 years. So for the client who can afford it, get the same guaranteed death protection they need for their family or their estate or whatever, but you get the opportunity to build a whole lot more cash through index crediting. This is a nice piece. I wish we had more time to go into it. I recommend it to you. We can send it to you in PDF or print form. It explains the index crediting in a nice color-coded fashion. This happens to be for the 5-year account. We've got a similar one for the 1-year account. This is consumer approved. It's part of like a 4-page piece that explains it all. But just quickly, the years, this is the 5-year account, so the years down the left-hand side here are the end of every 5-year. All of those are the end of a 5-year increment. We see how the 3 indexes have done over that period of time. We throw out the worst, we overweight the best, and then we apply our participation rate and we credit that interest. And over time, because you got 3 indexes to choose from in 3 different economies and you're always throwing out the worst and overweighting the best, you've got the potential, we feel, for superior crediting. Again, we think indexed UL and choice index in particular answers what the market's looking for, what they've told us they're looking for. Not to downplay our other products, but we think this product is the best fit for the most people. I'm going to skip through Elite Global given the time. I would say that's for the very upper end of the market who want to pay the absolute highest premium for a short period of time, 5 to 10 years. It's got the same 5-year index crediting strategy as well as a 1-year strategy. But just to sum up indexed UL, a lot of reasons to think of American General here. We are a pioneer. We've got a diverse yet innovative portfolio. But what isn't listed here is we do not play games. We don't have artificially high caps or participation rates that look good on illustrations, but which are not sustainable. We just don't want to play that game. You can see we have $8 billion of indexed UL face amount in force, so $180 million of premium. This is not our first rodeo when it comes to indexed UL. Rolling targets I've talked about. We've got them on all of our ULs. A couple quick points, Roy, and then I'm going to wrap up. You've heard Roy refer to the AG Quick Ticket. AG Quick Ticket is not a product. It's a submission process that we make available on both term and guaranteed UL. The name of the game here is it saves time. It simplifies the process. You drop a ticket online. Somebody else, the Pyramid company, does all the work in the background. It's less paperwork. It ensures that your application is going to be in good order. Roy's got this up and linked on his system already. So going to get particularly if you're not working in the life insurance business every day and the paperwork is overwhelming and you don't want to deal with exams and scheduling parameds. And, this is a quick way to drop a very short form application for term, ROP term, or guaranteed UL and let somebody else do all that paperwork in the background, and hopefully the next thing you hear is that the commission's ready to be paid. So I think Roy's got a bunch of material on this. He's got the link, I think, already on his website, and at the end I'll let him mention that and talk about that if he wishes. Last thing I'll mention before I shut up is, for those of you who may work at the upper end of the market, there is what probably will be a unique gifting opportunity in 2012 for your higher net worth clients. We've got the $5 million plus exemption. We've got the lowest gift tax rate we've seen in a long time. It's probably going to go away one way or another at year end. This is a great opportunity for folks to consider lifetime gifting if they've got a large estate. We've got some pieces around that, consumer-approved pieces. We've gone one step beyond why it's a good idea financially. We've got some stuff that talks about how you actually do that. You know, how do you make a $2 million gift? What property should you consider gifting? How do you figure out what it's worth, and so forth? So if that's the market you're in, or you think you might have some clients that are in, you know, again, Tom can fix you up with some materials. That is a lot of talking by me, and we covered an awful lot of ground in 60 minutes. I really appreciate you hanging in with me. I know some of it was very quick and some of it was very high level, but again, if you want to know more, I can help you, Tom can help you, Roy can help you, and you know, at Roy's choice, I'll be also happy to explore any of these topics in more detail in the future. So at this point, I will open it up for any questions, or Roy, any final comments for me or among the group?
I don't see any questions coming up. So, guys, the quick ticket is actually, if you go to the carrier index, just choose American General Life, and then you'll see it right there on the front page. The Rapid Rater will also be there. I think she's actually putting it up as we speak, so you'll be able to have that as well. The quick ticket guide, I mean, we're actually working to get that into iPipeline as well. I think, I don't know, there's something that they have to actually do in there to make that available to you, but you can actually just go to, like I said, the carrier index, just choose American General. It's right there on the front page. You click it. If you kind of know the information, and guys, that is a very good tool. I know there's a competitor that has one basically like that, and you know, we get a lot of apps on that, and it's very simple on your part. You know, you don't have to. It's kind of like Mike said. I mean, you basically, all the things that we usually, I wouldn't say fight an agent for, but I know it's the things that has to be done that nobody really wants to do. Order the pyramid, you know, all the stuff with the application. It's just a very easy way to basically write business. You know, then you can move on to the next one, and they handle basically all the heavy lifting for you. So.
Yeah, early feedback, we've done a lot of cases on it already, and early feedback's very positive, and they've already enhanced it a couple of times and plan to continue doing so.
Yours looks a little more robust, if I must say, because I've looked at both, and it does look a little more robust in the things that are in it. And guys,
we have the advantage of being second to the table and asking people, you know, what would you like you don't have today? So.
Sure. This is another question I know we always ask, but I know this does not cost you anything, so I just want to make sure that you know that. Some people think this is something that we're trying to sell or you're trying to sell to them, but so this is, you know, something that's there, it's available for you, it's a resource, you know, that's at your disposal. You can use it or not. I would suggest that you do, because it's we have a lot of guys that are in other markets, and for some reason, I don't know why, but for some reason the life insurance industry kind of scares them. They think it's a whole bunch of paperwork and applications and things that you have to do. And this is also an easy way for someone like that, you know, to get in, to write a case in this without having to be, you know, if you're in the senior market, you know, and you know that, and you're trying to take care of that, but you have this case, this is an easy way to basically step into this without all the hassles of, you know, do I have the right app? Do I order a pyramid? Do I not order a pyramid? You know, are they going to know what to actually do in the pyramid? Which obviously the answer is yes, but you know, if you don't know that, it's just a very stress-free environment to be able to write that app.
When to ask that follow-up question if they give a yes answer on something, you know, that you don't have to deal with any of that.
It's a very good system. Tom, Mike, I appreciate your time, and
we appreciate the opportunity, and thank you very much for giving it to us.
I think that we had a guy on here. He was trying to make me hold all the questions because he was trying to get out for an appointment, but we'll make sure that we get him that information as well. I think he's already gone, but And we definitely, I want you guys back. Maybe we can kind of jump into a specific product and maybe kind of drill down a little bit deeper.
Yeah, do some sales scenarios or whatever, yeah.
That would be great. So
you bet.
I appreciate you guys that are still on the call. I appreciate you here and taking your time out of your day to do this. I hope it's been valuable to you. And if you got any questions, either Chuck here at the office, I think I put Chuck's number up. Chuck can probably answer most of those. I don't know, Tom, if you want them calling you or...
Tom had to step out. He's not here, but yeah, they're all welcome to call Tom as well.
Sure. Well, I think most of you, if you give Chuck a call, Chuck will be able to help you, or actually some of you guys that work with the marketers, senior marketers, they should be able to help you as well in these products. So with that, I appreciate you.
I was going to say, Chuck at the extension 732. Give me a call if you have any questions with the product. I wanted to add real quick, there's a lot of insurance companies out there that can quote aggressive rates. But what I'm finding, American General, we're getting some very good offers back through the underwriting process. Big difference between what's quoted and what actually comes back in real life. So their underwriting has been very good lately, and so keep that in mind when you're looking at what company you're trying to pick. So
that's good to hear. Our chief underwriter's right down the hall. I'll make sure. Maybe I shouldn't tell him that.
Yeah.
I don't want him to
don't tell him that. So.
So no, very bad. When you still need to push them down, we still need to push them down.
Right.
So
Thanks
again, I appreciate
guys.
you guys. Thank you, Chuck, for jumping in there. Tom, make sure you tell Tom and Mike as well to appreciate your time. And
hey guys,
if you guys have any questions, please give us a call. Have a good day.
Thank you all.